In today's video, I want to talk about how you can use your assets in a way that will minimize your lifetime tax bill. Now, if you clicked on this video, you're probably somebody that is retiring soon, or you have retired recently, and you're wondering, what can you do to minimize the amount of tax that you're going to be paying, because that tax is a big tax drag on your assets. You might have $2 million or $10 million or $20 million that you're trying to decide, how do we spend this? Which account should we spend from first? And how do we make sure that we're not overpaying or paying more than we have to in taxes? So I want to talk about this with you and think through, what are the assets that would be better for you to spend, and what are the assets that would be better for you to leave? Now, that's going to vary a little bit depending on your situation. How much spending do you want to do during your lifetime? How much do you want to leave when you're no longer here? What amount of money needs to be in each of those buckets to support your spending and support the amount that you want to leave? And once you know how much needs to be in each bucket, then you can begin to divide up the assets that you have into the best bucket for them. Now, during your lifetime, you're going to want to spend money out of your tax-deferred accounts. This would be your traditional IRA, your traditional 401k, your traditional 403b, anything that you have not yet paid tax on, and you're going to be paying tax when you pull it out. So you want to pull that first up to the lower tax bracket. So fill up the lower tax bracket with that amount of money. You can also use those dollars for charitable giving once you're 70 and a half or older. And that will eliminate tax on those dollars. So if you're somebody that's charitably minded, as a lot of my clients are, then it makes a lot of sense to have money in that traditional IRA that you can use to then give money to the charity, because nobody's going to ever pay tax on those dollars. Now, after that, you're going to want to look at, well, what income do you have coming in, or can you have coming in? Interest on money that's in your taxable brokerage account, the dividends on the stocks in those accounts, or maybe you have rental income on rental real estate. That's going to cover your cash flow. You're not going to be spending the actual asset itself. You're going to be using the income from that asset to support your income during all the years that you're living. If you're beginning to get into some of those higher tax brackets, you've filled up the lower tax brackets, and you're pulling all of the income that you're receiving and you're spending that, then you can dip into your Roth IRA to make sure that you don't go into a higher tax bracket. And that will help you with your IRMA costs. That's the income related monthly adjustment amount for your Medicare premium, and it will help with the tax bracket management as well. It will also help you think through future tax rates. So you want to always be mindful of your current tax rate and your future tax rate, and what is going to be the difference there. If you have health needs, then you can also use your health savings account for tax-free income. That's assuming that you had saved up a health savings account where you were still working or still eligible to contribute. On the other side of the ledger, money that you're going to be leaving to your family, you want to think about things that they can receive either tax-free or with some kind of tax advantage. And that would, first of all, be your Roth IRA. They can receive that Roth IRA, inherit it, pay no tax on it, even allow it to grow for another 10 years, maybe longer, depending on the beneficiary, but another 10 years for the majority of beneficiaries, which would give them time to double what they had received. And at the end of that period of time, when they have to take it out of the Roth IRA, there's no tax on it. So that is a very good asset to leave to your heirs. You can also leave them those stocks that you're receiving dividend income from, or the other assets that are in your brokerage account that have a capital gain to them. Your heirs will receive a step up in basis, meaning that the capital gain that you have if you sell the asset is going to go away, because they'll get this step up in basis at the point in time that they inherit it, and they can immediately sell that if needed and pay no tax on. There'll be no gain to them, or they can hold on to it. They can collect those dividends themselves the same way that you were, and they will pay tax on the future growth, but not the growth up into the point in time that they inherited it. So that's a big tax advantage to your heirs. That also applies to rental real estate. So if you have rental real estate, it's a good asset to give to your heirs because they will receive that step up in basis, be able to sell it, not have a capital gain on that. The worst assets to leave as an inheritance would be those that your heirs would have to pay ordinary income tax on. So that would be the traditional IRA that you have or traditional 401k. It would also be any annuities that you might have because those don't get a step up in basis. Even if there is gain from the point in time that you inherited it or the point in time that you set it up until the point in time that they inherited, that gain is considered income in respect of decedent. It is not considered capital gain that gets a step up, so they'll always pay the tax on whatever that gain is. And then your HSA, that is also not a good asset to leave because your heirs don't get to take that over as an HSA. They're going to have to pay the tax on that. They're going to have to cash that out and go ahead and settle up on the income tax on that. So when you're thinking about which assets you spend versus which assets you're going to leave, you'll want to think through how are you taxed during your lifetime? How will your heirs be taxed when they receive it? And then put a plan together that makes sure that you have the assets you need at each point in time that you need them, and what is left is going to hopefully be the very best of all worlds for your heirs. But in the meantime, making sure that you have minimized your tax liability year over year to the best of your ability to do so. So it's a bit of a working puzzle as you go along, but it's a very good puzzle to work on because by minimizing your lifetime tax bill, you're going to be able to keep more for yourself and more for your family.